China has responded to Trump's import taxes with a 34% retaliatory tariff on all U.S. goods entering China. One industry that could be hit hard is farming.
The prices have declined for the three major commodities that are facing us right now: corn, wheat, and soybeans are all down, and farmers depend on those three commodities to hold on to our farms. So farmers right now are facing really trying times, and the president is going to put a lot of farmers out of business like this.
In April 2025, a seismic shift in global trade reverberated across markets, ports, and farmlands. A cargo ship laden with U.S. soybeans halfway across the Pacific received an abrupt rerouting. Trading terminals in Singapore lit up with a quiet but devastating alert. China had canceled all U.S. soybean shipments, effective immediately. Within hours, 2.4 million tons of soybeans were diverted to Brazil, and by sundown, $1.1 billion in U.S. farm contracts had evaporated. This wasn't a trade war. It was a controlled demolition, and soybeans were merely the fuse. The cancellation wasn't a random act. It was a signal, one that rippled far beyond agriculture. 40 ships were rerouted, and a multi-billion-dollar trade route snapped like a brittle twig. This wasn't a glitch in trade logistics, but a deliberate stress test of U.S. economic resilience. Wall Street took notice. The Pentagon took notice. When your largest customer halts mid-delivery without hesitation, you're not just losing a market, you're being measured. And America, it seems, cracked under the pressure. Bloomberg first reported that China had abruptly canceled soybean orders from three major Cargill, ADM, and Bunge, citing strategic procurement adjustments. By the end of the week, Chinese buyers had secured 2.4 million metric tons of soybeans from Brazil, totaling over $1.1 billion, according to customs data tracked by S&P Global. This volume represented nearly one-third of China's typical monthly soybean imports. While Beijing didn't publicly frame the move as retaliation, the timing was telling. The cancellations came within 48 hours of President Trump's latest tariffs on $90 billion worth of Chinese goods. Economists at Rabobank warned that this could mark a pivot engineered to dismantle U.S. agricultural. The question is whether this is a short-term maneuver or the beginning of a structural rerouting of global food trade. The fallout in the U.S. was immediate and measurable. The USDA's April 2025 soybean report revealed a 13% surge in unsold domestic soybean inventories, pushing storage levels to their highest April figure since 2019. Spot prices at the Chicago Board of Trade plummeted 8.2% within days, wiping out over $470 million in commodity value in a week.
Good morning. Well, China has been the leading importer of U.S. agricultural goods for the last several years. So this trade dispute with Beijing has the owner of this 800-acre spread in Illinois worried about how it may change the landscape of his business.
In Iowa, grower sentiment collapsed. "We've been shut out mid-season with no contingency," said Matt Dunn, a fourth-generation farmer in Des Moines, in an interview with the Wall Street Journal. This is no longer economic isolation. The American Soybean Association estimated that China's exit could slash farm incomes up to 18% this quarter alone. The Trump administration's 20% tariff on Chinese electronics, metals, and EV components, announced on March 10th, was meant to pressure Beijing ahead of trade talks. Instead, China's response struck at one of the few U.S. exports it still relied on: agriculture. Soybeans were no ordinary crop. In 2024, the U.S. exported $14.3 billion of soybeans to China, making it the most extensive bilateral trade export line. China is hitting Trump's base where it hurts: rural voters and farm states, said Chad Fellow at the Peterson Institute in a CNBC interview on April 2nd. The USDA confirmed that farmers in 11 Midwest states now face a moderate to high risk of insolvency due to canceled forward contracts. As pressure mounts, the trade war is becoming a domestic political liability for Trump. But this story isn't just about soybeans, it's about strategy. Brazil's ability to step in wasn't luck, it was calculated. Between 2020 and 2024, Brazil expanded its soybean acreage by 21%, backed by over $11.2 billion in agricultural infrastructure investments. China's state-owned development banks financed grain terminals in Santos, expanded freight corridors from Mato Grosso, and co-funded the Ferrogro Railway, cutting internal transport times by 42%, according to a February 2025 Reuters report. This infrastructure laid the groundwork for China's pivot. Bloomberg Intelligence reports that Brazil can now supply 7 annual soybean demand. With fewer GMO restrictions, looser environmental standards, and stronger bilateral trade protections under BRICS agreements, Brazil's rise may be permanent. Is the U.S. being replaced, not just priced out, but planned out? The timing of China's move was surgical. According to USDA trade data, March through June is the peak profitability window for U.S. soybean exports, accounting for nearly 40% of annual revenue. By pulling out now, China triggered a cascading sell-off during America's prime shipping season, undermining both price and volume. Brazil's harvest wasn't even at full capacity, yet China knowingly paid premiums, reportedly $14 to $22 more per ton, according to traders cited by the Financial Times. Why overpay? Short-term losses can yield long-term control, argued an analyst with China's Ministry of Commerce. This wasn't just about soybeans, it was about leverage. China cited phytosanitary concerns, pointing to fungal residue and pesticide traces in U.S. soybean shipments. However, as of April 2025, no violations have been confirmed by the USDA or the WTO complaint database. U.S. soybeans consistently meet international food-grade standards, with contamination rates below 0.01% per a joint audit by the FDA and GAFTA. Trade analysts are skeptical. There's no precedent for safety-related suspensions without prior warning or inspection delays, said Andrew Tilton, chief Asia economist at Goldman Sachs. China sidesteps WTO scrutiny by invoking non-tariff barriers while signaling unpredictability to U.S. exporters. Is this a genuine food safety issue or a pretext for economic retaliation cloaked in regulatory language? China's soybean pivot didn't begin at the negotiation table. It started at the docks. Over the past 5 years, China invested over $8.3 billion in American logistics, including equity stakes in Brazil's port of Itaqui, a $1.2 billion expansion of the Northern Grain Corridor, and direct investment in the Ferrogranal Railway, which cuts transport costs from Mato Grosso by 35%, according to the Inter-American Dialogue. These aren't just trade routes, they're geopolitical corridors. By embedding itself in the infrastructure that moves Brazil's soybeans, China has reduced its dependency on U.S. commodities and on U.S.-controlled global choke points. In 2024, over 64% of China's soybean imports flowed through logistics networks with direct Chinese involvement, per Bloomberg. As one Carnegie Endowment policy analyst said, Beijing is no longer just buying food, it's buying leverage. But what if food isn't the end game? Soybeans may be the headline, but corn is quietly slipping away. Between January and March 2025, U.S. corn exports to China fell 29% year over year, according to the USDA's Foreign Agricultural Service. Meanwhile, China finalized a 3-year corn import agreement with Brazil's CONAB agency, covering up to 9 million tons annually, worth an estimated $2.6 billion, as reported by Reuters on March 28th. In March, China's State Grain Reserve auctioned 1.2 million tons of U.S. corn, citing price instability and strategic rebalancing. Industry insiders argue the real issue is trust. After escalating tariffs and controls, Beijing views U.S. agriculture as unreliable. This isn't diversification, it's insulation, said Joseph Glauber, former USDA chief economist, in a Wall Street Journal interview. If corn is next, what follows? Wheat? Sorghum? The shift raises a larger question that U.S. markets are only beginning to grapple with. According to HSBC's April 2025 commodities outlook, China has signed or renewed long-term import contracts with Argentina, Brazil, Russia, and Pakistan, covering over 70% of its grain and oilseed needs. In contrast, U.S. agricultural exports to China fell by 26% in Q1 2025, cutting $3.2 billion from trade flows, per Census Bureau data. Some believe a diplomatic thaw could reverse the trend, but China's infrastructure investments and intent suggest otherwise. What we're seeing isn't just de-risking, it's disconnection, said Jennifer Harris, a former National Security Council advisor, in a Bloomberg interview. With political relations expansion offering alternatives, the question isn't whether the U.S. can recover market share, it's whether Beijing even wants to return. Soybeans were just the first fuse. China demonstrated it could abandon a $14 billion commodity and replace it in 72 hours with no delays, shortages, or domestic political fallout. This wasn't just a trade dispute, it was a proof of concept. What happens when China applies the same strategy to semiconductors, rare earths, or U.S. treasuries? What if the next pivot isn't about soybeans but the dollar itself? That's not just a question for farmers, but for Wall Street, Washington, and the global economic order. If soybeans were phase 1, what is phase 2? The world is watching, and the answer may reshape trade for decades.
सगळे कुपणे कोणीच तयार जाऊ चॉकलेट ते बदे की त्यांना 5 रुपये ना ना म्हणा दाखवायचं कॅमेरा चेक कर